Welcome again today. Real important subject matter, and we're going to cover today a few different subjects on how you draw down different strategies to drawing down your savings. You know, the whole purpose of saving for this is to replace your income, create an income stream in and through retirement, obviously. And so we're going to focus on 5 specific withdrawal strategies and also talk a little bit about risk as how it goes to. We have a whole nother module on shifting your risk that will come as well, but I wanted to talk a little bit today as a preference before that comes out and before we do that as well. Thank you all for being here. Hope you all have had a good couple of weeks. I know it's an extremely busy part of the year. If you have children in school, high school, spring break seasons upon us, my sons, both of my kids' spring break is next week. And between this and trying to get some other webinars for other clients in, we're just in the same boat that you are. We're just moving at the speed of light, it films. So today, let's get right to it. We're going to really talk about withdrawal strategies, and it's really just, how you plan to get your money out of retirement specifically. Um, and 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 really how you withdraw it is really even more critical, and how much you withdraw is even more critical than how you saved it. But before we kind of get to that, I really just want to talk through the basics and some questions that one that I've gotten every year without fail from people is, how do I access my money once I retire? So we're going to really just talk about the basics of accessing that money. If your money is staying in a 401k or an employer savings plan, like a qualified plan, so say like a 401k or a 403b, if you've in that, in my experience, typically custodians, there's pros and cons to all this, but in my experience, typically custodians of the 401ks and 403bs will charge a fee for withdrawing that money. The fee is plan specific, so I can't sit here and tell you that it's X. I see it anywhere on the plans that we serve, anywhere from $25 every time you do it up to $100 a pop. The plan also will dictate how often you're allowed to take those distributions, whether it be monthly, quarterly, semi-annually, or some plans only allow an annual distribution. So it's very important to kind of get a frame of reference of what the rules are for each of your specific plans. You can contact your custodian. They will know those rules, or reach out to us at MCF, and we're more than happy. We have that information at our fingertips, can help you do that. When you withdraw money, and if you leave it in the 401k, the industry standard for withholding taxes is 20%. And in most cases, that's non-negotiable, meaning that even if you're not in the 20% tax bracket, the record keeper or custodian will force you to withhold 20% of whatever you're taking out. On the flip side, one of the positive things that they will do is that the custodians and record keepers will determine your exact amount of your required minimum distribution. If you don't know what a required minimum distribution is, starting at the age of 73, if you had not started taking money out of your account, or you're not taking an applicable amount, the government then requires for you to take out what's known as a required minimum distribution. That distribution is a factor that is multiplied times your December 31st balance for the next year, and it starts in the year that you turn 73. From there, that factor escalates, meaning that as you get older, the government requires you to take out more. So I like to say in layman's terms that you've done really well saving your money all this time. And the government essentially gets tired of you hoarding your own money and forces you to take out a certain amount every year, and it escalates the older that you get. I will say that for those that are 9 years away from retirement or more, the required minimum distribution age will escalate based on the Secure Act 2.0 that passed a year ago last December. It will escalate to 75. So for some of you, that might be 73, and for others, it's going to be 75. It depends on um, uh, where you're at in that process over time. Um, the other option that all of you will have, instead of leaving it in a 401k and accessing that money, meaning taking withdrawals either periodically or annually, is that you would have the option to roll over to an individual retirement account. Sorry, individual retirement account. An individual retirement account, or an IRA, as we'll refer to, is a qualified account that is specific for you. You're able to roll your money from your work plans, your group dollars, to an IRA. If you're saving it in a pre-tax, that will go to a traditional rollover IRA. If you're saving in Roth, you would need an additional one that will go to a Roth IRA. But then individual retirement accounts, typically, I can't speak for the entire market, but most of what I see is that those accounts are fee free of withdrawals. Sorry. So there's typically no fees. Now, obviously, that's specific to the IRA and where you open it up with and who. But in general, there are no fees. You can also set those up as you can in very minute amounts of the 401ks, but you can set those accounts to have withdrawals come automatically, meaning that you could arrange for a certain amount of money to come on X date that you want it to, whether that be monthly that you take it, whether it be quarterly that you take it, or semi-annually or annually. You can set those up to where automatically that comes to you, direct deposit into your bank account. So that can be set up electronically. A la carte can be done with no fees, meaning that if you, let's say you're taking $2,500 a month, you're getting that comes every day, every month at whatever day you choose. You can access more and get money on top of that should you need extra money. So it's not as if you're not handcuffed into one position or the other. IRAs allow you to withhold taxes at whatever rate you want to, or none at all, meaning that you can actually withhold the amount that is appropriate for you. Let's say your effective tax rate is 13 or 14%. Let's say 14%. You can elect to have 14% in federal taxes withheld on all of your distributions, as well as a state tax amount to that as well. And you get to pick that amount. So a little bit more latitude versus the 401k. The industry standard is 20% across the board. Now, RMDs in terms of that are not figured. If you're an individual retirement account and you're not working with an advisor or anybody, you would need to figure the RMD yourself, which there are tools, and there are the factor tables for the IRS are out there that you can do it on your own as well. If you can also, depending on the custodian, let's say you have an IRA with Fidelity, but you don't have an advisor, you can call Fidelity and request that they help you figure out what your required minimum distribution for that year is as well. Typically, I would say this. In general, I'll advise, and very in general, there's some people I advise to leave it in, and there's some people I advise to roll it to an IRA. It all depends on what's best for you in that pros and cons list. I will say this, when you go to an IRA, you get to choose your investments and you get to pick anything from the universe outside of the plan versus the 401k. You have to invest within your plan. Another thing of latitude is that as you shift your risk down and you're taking less risk, which we'll talk about a little bit later, there are more options in general. There are adequate options in 401ks, but there are a lot more options that you can get creative on the fixed income side, meaning bonds and some of those things that are like, interest bearing, or predictive yield scenarios. In a fixed income scenario, there's a lot more options that you can choose from, obviously, in an IRA. If you're running it yourself, it's on you to kind of pick that and do it. If you work with an advisor, obviously that's what you're going to go with them for. Looks like one question I'm going to get real quick. Is there a downside to drawing monthly versus quarterly or annually? Awesome question, Angie. And I was going to get to it, but I think I might have forgotten if I didn't really stop and do this. So great question. Yes, there is. As an advisor, I prefer people take money out closer to the manner in which they put it in. Why? When you're saving this money, you're putting it in every 2 weeks because of your pay periods from work. That's what average is. Some people go in weekly, but you're putting it in more often than just once a month. I don't think you need to take it out in the same manner, but monthly is closer to the biweekly. Obviously, you're going to stay invested. We'll talk about the risk later, but you all know the stock market goes up, the stock market comes down, the stock market goes up. I like you taking it out in a more frequent amount of time, closer to the amount that you put it into, because at any given time, you might pull money out of that and that account is down. If you're pulling money from assets while the account's down, it's money that generally does not have an opportunity to regain the return. Obviously, you pulled it out. We'll talk about the risk portion of that at the very end, and it'll make a little bit more sense. But pulling the money out more frequently allows you to kind of average the ups and the downs of all the markets, if that makes sense, versus let's say you take it out annually or semi-annually. And when you're doing that, what you're pulling from has to be down by X%. It never has a chance. The portion of that money that you've been able to do over the course of a month or quarterly won't have a chance to repair itself if you're taking it out on a less frequent manner. So I hope that makes sense. Great question. I really believe that's hopefully that answers that there. So one more. Thomas asked, if someone retires before 59 and a half years old, can money be withdrawn from the 401k without penalty? Or do we need to wait till after 59 and a half before we start making withdrawals to avoid penalties? Another really good question. And Thomas, I'm going to be that guy. I'm sorry. It depends. I'm going to give you, because I don't want to get into the weeds too much of this. This would be a really good question for you and I to interact individually on. But the real answer is it depends. A lot of people will go out there and they will find a statute known as the Rule of 55. The Rule of 55 does not apply to every plan. It has to be elected. And even to meet the Rule of 55, it means that money has to be left in the 401k. It can't be moved to an IRA. An IRA is 59 and a half hard stop, okay? Unless it's Roth. We'll talk about that later. Unless it's Roth. If you have Roth money, then you can take money out as long as you've established it for more than 10 years, meaning you've had the account for more than 10 years. You can take Roth dollars out to the extent of what you put in before 59 and a half. But IRAs are hard stop 59 and a half. 401k plans, it depends on that Rule of 55. If it's available in your plan. And the key is it's supposed to be your last stop of employment, meaning you're not supposed to work for anybody else or anything else moving forward. It's extremely gray. It's extremely vague, and it's different for everybody. I have come across people that the rule of 55 applied to. It was their last stop, and they were going to withdraw the money from the 401k. In that manner, it allowed them to do so. But in the vast majority of cases, I would say on that, Thomas, 59.5 is the number that most of us have to achieve. Okay. I know that doesn't fully answer it, but that's as far as I'm going to go because there's some intricacies of the rule of 55 that get very confusing. But in general, I would say the vast majority of plans and people are 59.5. So we'd have to look at a couple of things anyway. So I'm going to mark those both answered and that. Any other questions in terms of the basics of accessing your money? In terms of pros and cons, it's different for everybody. I tend to lean once you're starting to pull money out, not necessarily when you retire, but when you're going to start pulling money out, I tend to lean to IRAs because of the latitude of less fees and the options in terms of creating a larger, better fixed income portfolio for yourself in terms of that. Okay, moving right along. So considerations, we talked just a little bit about this. Are you going to delay taking your withdrawals? Are you going to start taking withdrawals earlier? Obviously, the longer you delay, the more beneficial it is to making your money last. I don't think that's clairvoyant to really anybody, but it is true and it makes a big difference. Are you withdrawing only income from the investments of your portfolio? Meaning, are you, instead of getting dividends, return to the portfolio, are you living off those? Are you going to delay withdrawing from a Roth until later? You're going to take it up front. You've got to worry about like how much you're taking out of these accounts, and withdrawing too much too soon, obviously, is a consideration, not necessarily of should you leave it in the IRA or the 401k. It's just a consideration in general, to make sure, that you don't run out of money too soon. It goes back to those three questions. How much money do I need? When do I need it? When am I going to start it? And the last one is for how long? We don't know that. Plenty of calculators out there that you can use it. The biggest consideration is just winging it. I've come across this a few times. The reason that we did this one live is because I think it's important, and it will give you 5 different ways. And there's more than 5, by the way, but 5 different ways to approach taking money out that are safe and systematic. That will be a plan for one way or the other for you to kind of work on and go with. Don't just wing it. Have an idea of how long your money's going to last based on how much you're taking out. And then a lot of that will go to this next. There are always questions that have to be asked when retiring and determining which strategy to take. And that is, when do you need the money? As I said before, how much you're going to withdraw and the last for how long. But there are also factors that we cannot control in this thing. Longevity. We don't know how long we're going to live, and we might retire at 65, and we might, there's going to be, odds are someone on this call or watching this video is going to be close to making it to 100. We're living 10 years longer than our parents, 20 years longer than our grandparents, and that will continue to increase over our lifetime slightly as well. Investment returns. Are you too risk averse? If you don't have your money properly invested, taking a proper amount of risk, then you might outlive your money because you're not, getting a reasonable return. Or maybe you're taking too much risk. That's an easier one to see for me. If you're taking too much risk, the dips in the market might, and while you're pulling money out, might cause what's called sequence of returns risk. We'll get to that a little bit later. But that is a big one that can really hurt your future value of it. So inflation, we can't control inflation, but we know it's there. We have to account for it in a lot of this. And then future expenses, the unknown expenses. That's the ones that are hardest. We talked about that last time as well. But these are all things we cannot control. If you wanted to understand a graphic in terms of how inflation does affect our spending over time. This is assuming a 2.5% rate of inflation, which is what the Fed's expected rate of inflation is over time. That would mean $120,000 today you would need to have 153,000 at retirement to cover, and then over 280, almost 285,000 that you would need to have giving the same amount of money at life expectancy over time. So inflation's real, and over this is a 55-year-old couple making 150,000 a year. And the 120,000 is 80% replacement income. So 120,000 today would mean at your life expectancy, that would need to be about 285,000. It's pretty staggering if you live long enough. Okay, so let's start with strategies. The first one, some of you might have heard or have seen, the 4% rule. The 4% rule is simply when you withdraw 4% of your retirement savings in your first year of retirement, and in subsequent years tack on maybe a little bit for inflation, 2% for adjusted for inflation, but you're trying to not take out more than 4% of the principal of your money every year. So, for example, if you have $1 million saved under this strategy, then 40,000 is what you would take out during your first year. With inflation, the second year it would be 40,800, and the third year it'd be 41,616, and so on and so forth. It's not a fixed amount, but it's 4% is what you're trying to keep it near and close of what that of your principal. In general, this is a great one. It's easy to understand. It's long standing in terms of something quick that we can go to say, hey, if we're taking out more than 4% of our balance, that could be detrimental, because what it's saying is that over 4%, you could run out of money if you live long enough. Many retirees value this strategy because it's simple to follow and it's predictable. And for the most part, I would say I've not seen it not come through, and I've been doing this 25 years. So disadvantages, sometimes this approach is criticized for not considering the effects of rising interest rates and market volatility. And so if you have a deep stock market decline, you deplete risking your savings a little bit early, but that's where you manage the risk portion of that, not necessarily the withdrawal portion. That they go together, and we'll talk about that in a minute. But 4% rule, if you're going to call me up and you say, I'm taking this amount out and I don't have any other information from you, and I have your balance and how much money you need, I'm using the 4% rule real quick on my calculator. And if you're there or under it, awesome. I know you're going to be in pretty good shape before we even get into the weeds on that. You mentioned 4% of pulling the principal, or do you mean the total holdings? 4% could be just the growth of the original principal. Yeah, we'll talk about that one. That's a different one next. I'm talking about 4% of your holdings, your balance. So if you have $1 million, that's 40,000 a year is going to be your first one. You can tack on the inflation as used in the example, but the inflation is 2% on the amount you're withdrawing, not an additional 2%. So it doesn't go from 4% to 6% of the principal, if that makes sense. It's 4% of the total amount that savings you're going to be pulling from, and then you tack inflation on 2% on the amount of the 4%. So the 40,000, if you add 2% onto that, it's 40,800 the next year. In terms of that. And it does fluctuate. That's one of the things that's a con against it. The other one that you're talking about a little bit is there is a fixed dollar withdrawal. Some retirees will take out a fixed dollar amount over a specific period of time. For example, if you decide to pull out the 40,000 as an example annually, and then you would reassess that amount at the end of X period. So 5-year period, 6-year period, 3-year, whatever you choose. It is a fixed dollar. You're pulling out this amount every year, kind of regardless of what's going on in your account. Year 1, year 2, year 3, and year 5, you reassess. This is just really simplifying money management. And if you know exactly how much you need and you're able to do that, and it's not more than the 4%, then this is an easier way to kind of go with that. However, this strategy doesn't really go well for inflation. So you have to use ancillary stuff in terms of that. Additionally, in a down market, you might have to, liquidate more money because of the fixed dollar amount. But again, that more goes to, let's have appropriate risk for our investments, not necessarily the withdrawal strategy for itself. And you can see how these things are intertwined now. We want to limit the fluctuation as much as possible. I'll give you the way I do it at the very end. The next is a fixed percentage withdrawal. So this might be 4%, this might be 5%, this might be 3%. And this is a percentage based on the amount of money that you have. So fluctuate, the immediate disadvantage of that is fluctations will then account for less money that you're going to be able to get if your account is down. So in the example, let's say that you're going to take 4% out and you had $1 million, you're going to get 40% that year and your account value went up. Well, you get a little more of that next year, and then another good year in the market where your account value is sustaining and doing itself. But in year 4, it drops. You're actually $5,000 different than what you were in year 3. Some people don't like that, totally understand that. But it's a simple approach in terms of a fixed percentage withdrawal amount as well. That kind of thing. Let's see. I'll answer that one. Nope, I got that one. Okay. So yeah, a fixed percentage means just the percentage of going against it. No change for inflation. A systematic withdrawal was what you were alluding to. Who answered the last question? Who answered the last question was, let's see, Carl. Carl, this is what you were alluding to in terms of 5%, or a systemic withdrawal plan is where you withdraw the income that your portfolio produces. So let's say you have $1 million again, but your income from dividends and yield that you have, let's say that equals 5%. That's $50,000. Now, income to portfolio does go up and down. Sometimes people don't declare dividends, but yield from fixed income tends to be pretty steady. But you're not touching your principal in this case. You're only touching the income or the interest that is produced from your overall savings and portfolio. Great way to do it if you can, because you're not going to run out of money. You're only living on the earnings of which that has. So the approach, only touches the income, which is great, not your principal. So your portfolio should, in theory, be able to maintain itself pretty well. Disadvantages are you're going to withdraw. You're not going to withdraw the same amount all the time. You're just not. And you might get outpaced by inflation. It'll take a while, but you'll get outpaced by inflation at some point in time. So you might need to switch and go from that as well. The bucket strategy. When you all call and do one-on-ones and I have enough information, this is the strategy that I use most of the time, for a couple of different reasons. Number one, the amount that you have in each of the buckets is determined by the amount of your income needs. And I'll get to that in a minute. But in a bucket strategy, you withdraw assets. You're going to, and this is a simplification. Some you might have 4 buckets. We usually run about 4 buckets. In the example, I'm just going to show 3. you're going to withdraw assets from 3 buckets, or 1 bucket uniquely. Under this strategy, the first bucket would hold cash. So that's what we're going to pull, living expenses from, where your money's going to do that. And we're going to make sure that has a return. The second bucket holds fixed income securities. So like bonds, core bonds, stuff that makes more of a predictable return over a period of time. And the third bucket contains your remaining investments as stocks. Okay. So the cash is a simple, I typically just use the example as your fixed income bucket. Okay. By setting aside several years worth of living expenses in cash and fixed income combined. And typically what I do is 7 years. Okay. So let's go back and use the example. I'm gonna get my calculator here so you don't have to see it on the screen. But let's say your income need is 50,000 a year. Okay. But you're going to get 25,000 from Social Security. So I'm going to subtract 25,000 from that. Okay. That's $25,000. What that tells me is I would want to have several years of that $25,000, that income need, in fixed income and cash. Okay. I would want that number to be anywhere from 7 to 10 plus years. So at a minimum, if it's 25,000, I would want you to have $175,000 in fixed income, the safer place, and cash. Okay. If I want to go on the longer side of that, 10 years, that's easy math. 25,000 times 10, that's $250,000. And I want that out in fixed income and cash. And yes, you can stagger that, your fixed income bucket, so you know that cash will be available to you, but that money is making money. Why do I want that? I want 10 years of walking around money. If I've got it in an area that I know is not going to fluctuate as much, and yes, bonds can fluctuate, but it's less than what stocks do. And yes, it's dependent on interest rates. But if you hold bonds to maturity, it pays you what they promised to pay you. So let's take that part of it out. So meanwhile, you're pulling money and you got 10 plus years, because remember, you got a return, whether it be a savings interest rate on the cash guaranteed or the bonds. You have returns that's going to get that money. So let's say 10 years. Let's say you need 25,000 a year. That's $250,000 a year. That's 10 years of walking, 250,000 total. That's 10 years of walking around money, plus the earnings on that. So let's say, what bond portfolios are right now, forward-looking expectation might be about 5% today, a little bit more. But let's say 5% is the number. You're going to stretch that to probably 13 years-ish, okay? Maybe a little bit more, depending on how much money. Having that money in there, you have 10 years figured out. And the equity bucket, we know it's going to grow over time, but you don't have to pull from the money in the equity bucket while it's doing this. So meanwhile, let's just say we're focused on these 2 buckets. You're spending down this bucket. So year 1, year 2, year 3. But in a perfect world, your equity bucket would be going up. And at some point in time, we're going to trim the profits off the equity bucket and refill up these other buckets. So we're going to go from spending your money down on the fixed income side over those portion of the 10 years. And we're going to take earnings from your equity bucket and refill it to where they come back up. 7 years is an intentional number. The reason is the stock market tends to run in 7 to 10 year cycles. So I have gone longer than 10 years. In 2021, I was recommending people being 11 and a half in some cases. But 7 years is the typical cycle looking backwards from one high in the stock market to next. So no matter if you retire at the beginning of a stock market decline, you've got 7 to 10 years for that to rebound and go above. So you're not pulling from those growth assets as that. So to me, the risk that's determined by the bucket strategy is directly proportional to how much you plan to spend, how much you need from that bucket. And then maybe your fixed income bucket lasts you 15 years. Maybe it lasts you longer. Those are numbers that we look to get to. But it gives you a runway in advance. If you're retiring at 65, you know you've got money made to meet your income needs through 75, and then it gives the other buckets of money continue to chance to grow. So really, by setting aside your living expenses into separate bucket, it ideally gives it more time to grow and sustain, as well as not have to worry about the fluctuations of pulling money from your growth sides. Disadvantages. This one takes more time and planning to do. That's all I come up with. When you come to me in a one-on-one meeting, if you have how much you're spending and you have all of your assets in terms of your savings together and your Social Security and all those things, I'm going to figure your runway and how long your money's going to last based on a bucket strategy. Just me personally. I'm in this business. It makes sense to me. It's easier. So that's one reason why. Let's see. I don't think we have any questions on that. So the bucket strategy for me, it's how our firm in general, not always, but in general, what we refer to when we're doing planning for people in terms of that. Because it helps us determine how much risk you definitely don't need to take. For some people in that scenario, maybe their spending is going to cost them to have 60% or 65% of their money in the fixed income area. For other people, maybe it's only 50, maybe it's 45, maybe it's 40, but it's the number that's going to draw us to there, and we can really definitely see that a little bit easier. And then obviously the last is you can mix and match all of these approaches. You can do a little bit of the bucket with the withdrawal, the systematic withdrawal, definitely with the buckets. But you can kind of come up with your own. That's the beauty of this. Don't feel like you have to do what I do, what we do. It doesn't have to be that complicated in terms of that. One quick question from Gary. Thoughts on using a 401k or savings to bridge the maximum Social Security versus taking Social Security and lesser 401k savings at Social Security? Great question. In general, I use saving, and this comes down to when you're going to retire, right? And how much you need. I had 2 calls earlier today that in one of them, I had to stagger what the plan was in order for that person not to take Social Security at 62, but look at taking it at 66. She wanted to retire at 63. So I had like 3-ish years of pulling money from the savings before her Social Security was going to kick in. What was that look like spending that down? So my thoughts on that, General Gary, is that it's something you should look at. And the reason I say that is because there might be years when you don't get it. The way Social Security works is every year you wait. Actually, let me rephrase this. Every year before full retirement age. So for most people on this call, that's going to be like 66 and 8 months, plus or minus to 67. At least today, that's how that is. So every year that you take your Social Security prior to that age is at an 8% discount. But it's a little bit more because it's 8% a year, but that compounds. So it's 8% on year 1, another 8% on year 2. So it actually turns out to be a little bit more. Also, the longer you have income, the more you're paying into Social Security. Your average earnings, that calculation goes up from that too, assuming you're going to continue to work. But yeah, I do that all the time. And if you look at it objectively, like that person, if you're going to retire at say 63 and you want to wait to full retirement age or beyond to 70, obviously you don't get it. It doesn't go up anymore after 70. But if you wait to take that, it goes up 8% a year. That's a pretty good return on your money. But Gary, it's a math problem. It is to me. It's a math problem. And a lot of Social Security of when you take it has some break-even assumptions, again, going back to how long you think you're going to live. So my dad could have waited to 70 to take Social Security. He didn't. He had the means to wait. But he didn't because my dad didn't think he was going to live long enough to make it worth his while in doing so. And regardless of whether that became true or not, he said, I paid into this thing long enough. I'm going to start taking it as soon as I possibly can at full retirement age. And he didn't, and he continued to work until he was in his 70s, but he went ahead and took it. So yeah, Gary, that absolutely. I use 401ks as a bridge all the time for that. And then you kind of have to look, if your goal was 3 years from there, what does your balance look like at X date where you're going to take Social Security, and back into it, if that makes sense on that. But that's a great question. But that's exactly what we're trying to do here, is kind of stimulate that. So I think that's great. On the, I don't know why I done. Okay. So in a perfect world, and we're not in one, by the way, but combining risk with this drawdown, sorry, it's a mouthful, drawdown strategy. I get asked is how much risk I should take. The real question is it's a direct multiple to me based on how much you're planning to spend. But if you look at your risk tolerance and age, it definitely should influence your investment strategy. And comfort level with some people doesn't matter. I have people that are in their mid 60s that are going to keep it growth, and they want to do that indefinitely because it's their comfortability. It's just how they want to do things. And other people, I advise strongly against that. But in general, within 7 years to retirement, you definitely should no longer be playing the aggressive game, in my opinion. You should start looking to roll down your strategy as a general, and your risk tolerance as a general rule of thumb. I'll show you in a second how target dates do it and why they do that. Inside 5 years, certainly, once we start taking money out, 100% yes. Risk doesn't matter while we're still saving. All in all, it matters. It starts to matter as we get close to retirement. It really matters. It becomes essential once we start pulling that money out. So this is just a really a theoretical and general speaking that, when you're younger, you got more time on your side, but as you get there, you need to do that. What do you go to? If you're in growth, maybe you go to balanced. If you're in aggressive growth, maybe you 7 years out, you go to growth, which is more like 70% stocks, 30% bonds-ish, plus or minus, obviously. 5 years and in, you kind of have to look at that. Are you going to be balanced and do those kind of things? Target date funds kind of take that out for you, and some of you all might be invested in those. This is a glide path for the target date fund. So the red is domestic US stocks, the gold is international. This is 45 years to retirement, 25 years to retirement, 0 is retirement. This is how, in general, target date funds manage the fund. The longer you have to that expected horizon, the more risk you're going to take, way more stocks. The blue is the bond and fixed income portions of it. So if you look at that, as you're starting to get within that 5 year, you start to get near of that kind of 50-50-ish mix. And you get to a point that it stays static that way. Mostly probably 40 to 45% in stocks. It'll never drop down below that on a glide path for any of these target date funds. But you can see that the game really changes. That's ideal. The reason, as a general thumb, if you don't really know exactly the money portion of that in terms of risk, is this. Everybody on this call was working and was investing more than likely when 2008 occurred. That was the too big to fail drop. The market dropped 46.5% at one point in time in the year. It was down 39.9, I believe it was, 39.9, 39.8, something like that. If you were within 5 years of retirement and you just saw at one point in time in the mid-year, half of what you'd saved your entire career go away, that's an issue. The reality is, if you had 10, 20 years, 30 years, 20 years, and that happened, it's no fun. It's just punch in the gut just the same. But it's not the same as if you were that person within 5 years of retirement. It's just not. You got long-term to repair. You shouldn't panic. You shouldn't go against it. But those people in that 5 year retirement, in hindsight, we know how it ended. The government stepped in, intervened, and it allowed the accounts to rebound within a year and a half period of time. But the whole point is if you were within 5 years of retirement and 2008 recurred and you were 50-50 mix, you wouldn't have been down 46 and a half. You wouldn't have been down finishing the year at 39 and a half. It would have been more like 18-19 in a properly diversified 50-50 mix portfolio. And yes, 18% is a lot, but it's way different than 40. We all can agree on that, I think. So the importance of trying to realize where this risk is and where you're at is important. And I promise you this, it's always easier to put risk on than it is to take off. I will say this, if you're in that 5-year window and you're still growth oriented, now's a pretty good time to look at those things, and we can talk about your individual situations in the one-on-one should you choose to take it. Let's see. That's all we really have for today. I'm going to leave this up for a second. Reach out with questions. I'm here to help, here to shore up that gap in terms of those kind of things. Appreciate you all being here. Are there any other questions that that anybody wants to ask right now in terms of those kind of things? On the replay or otherwise, reach out. But any questions in terms of that? I'm going to stop the share so y'all can see me in full for just a short period of time. Any other questions on pulling money out? Anything at all? I got into, you're going to have a whole nother section that talks a little bit about more risk. It won't be live. It'll be a deliverable. But I hope that helps bring it together in terms of risk. I think everybody on the call intuitively knows they should take less risk as they enter retirement. But it is more of a math problem for me. To me, the bucket strategy and the financial planning is important because it helps inform you, ultimately the client, helps inform me, the advisor in the situation, on what risk you shouldn't take, way more than it does what risk you could. So to me, that's kind of the more important piece of when we're looking at those kind of things, being able to do that. Any other questions? There's nothing that's popped up. Still have a pretty good amount of people attending. During the crash, how far did nominal bonds drop? Initially, not very much. As interest rates went to zero, then over time they did. Remember this, Gary, and this is maybe better going back to 2022. So just a couple of years ago. Remember, there is an inverse relationship between bonds and interest rates. And if you remember what happened in 2022, interest rates went up a lot in a short period of time, the most they've ever gone up in the shortest period of time, in fact. So it made 2022 a really unique year. In fact, it was only the third time in history that the stock market and bond market were negative in the same year. That's pretty unbelievable over the course since we've been tracking those things. The bond market we've been tracking as a whole together since the mid 70s, 73, I think it was exactly. And the stock market goes back to since inception because we've gone back and aggregated the data of what like the S&P 500 and 1500 is. So only the third time ever. Remember, when interest rates go up, the prices of the bonds that you own in your portfolio drop. But it's only impacted as if you sell those bonds right then and there. Well, why would that be? Well, that's because if anybody wants to buy the bonds, they're going to buy them at a discount because the ones you hold are paying less than the ones that they can go on the street and find. But if you hold those bonds to maturity, the bonds, those losses that were there, at that moment in time that you looked, will amortize out, and the bonds will pay you the interest rate that they promised to pay you, right? On the flip end of that, when interest rates drop, the prices of the bonds you have in your portfolio go up. So over the next 18 months, my expectation is that interest rates will drop. I'm not saying anything that you probably hadn't seen a headline on. The Fed is going to raise interest rates at some point in time. I don't think they're going to do it as much as they said they did this year. I think we might get 2, maybe 3, maybe increases this year. But I do think as we move forward over the next 18 months, 24 months, interest rates will start to drop a little bit and go back down to help stimulate the economy. So in the scenario of which you were talking about in 2008, interest rates actually dropped. So the nominal yields actually went down as they repriced, but they didn't happen all at once. You could have sold your bonds for great gains as they decreased interest rates rapidly, but they did that process at much more over a longer period of time than what we did in 2022. Inflation got ramped up due to all the money being pumped into the system during as a reaction to COVID and the pandemic. We gave money to companies, we gave money to people, we gave money, here, there, and yon. When you throw money into the system, that is the fuel that burns the fire of inflation. There was a lot of it, more than I've ever seen in my lifetime in terms of those things. Inflation rose, and then the Fed aggressively, maybe lately so, in 22, aggressively raised interest rates, and it caused the bonds to drop and go negative, quite frankly. So in that, during that crash, it wasn't as big. It was spread out, and most of the time, bonds are spread out over a period of time. It's not as intense as it was in 22. Another question: what are the pros and cons of living off a 401k IRA or IRA, a Roth IRA, before claiming the max Social Security? Well, if you can do it, and you think your life expectancy is going to be long, then you're going to get that money. You're going to get that 8% all the way up into your 70. You're going to get more Social Security all the way up into the point that they don't raise it anymore, and that's after 70. Plus, you get the cost of living adjustments moving forward on top of that amount. So that in itself, if you can weather the storm and do that long enough, and you are going to live long enough, it's advantageous from that standpoint. The drawback to doing that and drawing down your saving assets, especially Roth, is you might have less money that you can leave if legacy planning is important to you. So you might have less of that you can do for somebody. But with the spousal benefits that can come from Social Security, the Social Security you'll see when we send that deck out, a lot of your planning in terms of that needs to be, it's very unique because it has to do with what your spouse's situation in relation to Social Security is as well. So if you wait and your spouse is not going to have near as much or any really Social Security benefit that they can pull from, waiting is advantageous because it's more money that they will get should you pass away, because they'll claim your Social Security. If they take the spousal version of that, then it's half of it, but they can't take it until you've reached a certain age, and you'll get all that. That's a lot of details in that when we tried to narrow it down as much as possible on the stuff that really matters in Social Security as well. Good questions though, guys. Good questions. What other questions do we have here? Anything else? We're coming up on an hour. I told you it was going to be shorter. I lied. I'm sorry. But we got into the weeds of some things. There's some good questions along the way. So I shouldn't really be sorry. I'm glad you're engaged. And I hope this is helpful. We'll get to it as more, but in terms of the first step is you decide how much you're going to need. Then you're going to decide where you're going to pull it from and where it makes sense. Does it make sense from a fee perspective to pull it from an IRA? Does it make sense to leave it in a 401k? What are all the things that go in, the positives and negatives of that? And you assess that. And then once you kind of figure that out, then you can figure out, okay, let's look at the strategies within that are going to make up the amount which we're going to do. And you can use all or a mix and match of all of those that we just did. So again, I'm a bucket strategy person by nature. Because I think it becomes very unique in terms of it's more close to what you need in terms of your spending need that you figured out versus the 4% rules in general, and that works, but it might be less money than you need or more money than you need. A lot of things that go into that one too. Anything else before we sign off? Last call. Last call. Okay, we will get the distribution of this video out and posted in the next day and a half or so. I will also email a copy of this slide deck for your reference so you can have as well to everybody on the call. I think we've got one more piece going out Thursday. And then we pushed a piece to go out next week. We'll only have one piece next week, and it is a read along. So nothing live. And then we'll hit the ground running and have several more things. We've got tax planning coming up around tax day, funny enough. We've got Medicaid, Social Security, all those things coming forward as well. Stay tuned. If you have any questions, get hung up on anything along the way. If you didn't understand or you want to ask something specific for you, I'm happy to help. I will be out in and out a bit next week, especially for the first half of the week. But I will email everybody as soon as I can with that kind of stuff. But that's all I have for today. I'm going to stop the recording and